Hey, good afternoon, Market Rebels, and to all of our YouTubers out there and those on Twitter watching us on live stream. It's absolutely great having you here. I was just watching going into the close. It looked like we were trying to stage a last-minute rally there on the SPY, but I think we're going to close down about maybe a point and a half or so. But at least we're not seeing a massive sell-off after our 5 green candles that we had previously. So that's certainly an encouraging sign. But trading tune-up. For anybody who's new, we do this every Monday, Thursday, and Friday, although we will not be doing it next Monday because the markets will be closed for the 4th of July. But generally, we're here every Monday, Thursday, and Friday, 4 p.m. Eastern. And the main idea is to give you some tips and tricks, kind of tools of the trade from professional traders that can help you make better decisions and therefore get better results. Now, if you joined us last week, you know that we were talking about risk versus danger. We talked about embedded butterflies, which I also said could carry some potential dangers in there. We talked about dangers with the stock replacement strategy on Friday. Today we're going to continue the topic with dangers in vertical spreads, and then tomorrow we're going to do another one with dangers in butterflies. And so my reason for doing this is to just show, even though they're fairly simple strategies, or at least what most people would think are simple strategies, it's very easy to step into traps and to miss the opportunities. So for anybody who likes to trade vertical spreads, let's take a look at some dangers in vertical spreads. Again, things you probably never would have thought of or thought to look. And that's what we want to show you here with the trading tune-up. So what are dangers? Remember, we talked about this last week. Dangers only expose you to losses. Now, of course, nobody is going to intentionally step into a trade that could only expose them to losses. So a classic example might be buying a 5-point spread for $5. Back in the day, we used to call those alligator spreads because you're up to your eyeballs in alligators and there's no chance of getting out alive. But of course, nobody would do that intentionally or even get close to that. You're not going to buy it for $4.80 or $4.90, at least hopefully not, no matter how good the odds are for making that last little bit of profit in there. But that's what we call a danger. There's really no additional benefit, but there is a potential large loss. And that's different from risk. We can manage risk, but there's absolutely nothing to manage with a danger. And the problem is they creep up on you. Because as market conditions change, these can start to appear, and if you don't know where to look, there you are, right into the trap. So again, dangers are this idea in finance where we call it where you're accepting risk for no reward or at least very little reward. So don't try to manage the dangers, get rid of them. But once again, you have to know where to look and how to exit them. So the problem, again, as I've mentioned here, is that dangers are often hidden. This is really the big problem. I think, again, most people would know it's stepping into it if it were not a real hot trade, but they don't recognize that it has crept up on them. So let's take a look at how that can happen in a vertical spread. Let's say that we buy the $100 call and we sell the 110 call. So we would say in the business that you are long the 100-110 vertical spread. Now, the risk graph is going to look like this. All right, as always, we get a bend at each of the strikes. So we can see the first bend lines up right there at 100. That's our long strike. And the second one lines up over here at 110. That's the short strike. Now, the maximum this spread could be worth by itself is 10 points. And that's because we have the right to pay 100 and the obligation to sell for 110. It would be the same idea if we did it with puts. But for this example, I'm just going to assume that we're looking at calls. So the most that it could ever be worth by itself is 10 points. But the thing that you have to understand is that vertical spreads are stackable. This is probably the key point that I think most people miss. They see it as one strategy, but they don't realize that there are smaller verticals underneath it, just like we saw with embedded butterflies last week. Same thing happens with vertical spreads. So let's say that you were to buy the 100-105 vertical spread. This is only a 5-pointer. There's our bend at 100. There's our bend at the short 105. But then let's say that you did a second trade. So you go right into your broker's platform and you do a second trade to buy the 105, 110. Right? So do you see what's happened? We buy the 100, 105, we place a second trade to buy the 105, 110. What happens? Well, once those trades clear in the account there, you're just going to be long the 100, 110. And so that's a way of showing that if you own the 100, 110, mathematically you really own two vertical spreads in there. You own the 100, 105, and you own the 105, 110, even though it doesn't look like it. So to succeed with trading, you have to realize if it's mathematically there, it's as good as there. And that means we have to watch it. So let's take a look. Here's the 100, 105 call spread. Long in green. I made it green to show that's the one we bought. Short one is in red. If you turn around and buy the 105, 110, what happens? Those trades cancel. Same strike and same expiration, but one's long and one's short. And I think most of you know you cannot be long and short the same asset in the same account at the same time. So the broker is just going to clear those out. And when it's all said and done, look what you're holding. You're long the 100, 110 vertical. So again, it's just a nice way of showing that even though you might have placed one trade for the 100, 110, you could have entered that identical position by doing two trades of the 100, 105 and the 105, 110. They are mathematically equivalent. And so what that means is that if we are holding the 100, 110, we might need to keep an eye on the 100, 105. So let's do an example. Let's say the stock is at 102, we have 30 days till expiration, and we buy the 100, 110 vertical spread. And under the assumptions I put into a pricing model, I think it was probably 20 or 30% volatility, but that doesn't really matter. What matters is that we are using consistent prices. For everything that I'm doing in these examples are run from a pricing model. So under these conditions, it says that this spread, the 100, 110, would be worth 350. And therefore, the max gain is 650. Why is that? Well, remember that the maximum gain is 10 points, or at least the maximum the spread can be worth, 10 points. But we have to back out the 350 price that we paid, and therefore, what would be a profit to us, or what we would call a net gain, would be these 650. So here's what it looks like now with some numbers on it. Here's the 350 maximum loss. We flatten out down here at 350. That's the worst that can happen. But if the stock price rallies up here to 110 or higher, that's why we flatten out this way. And that means you're going to be left with a 650 profit. Of course, you could be left anywhere in between. That's what this angled line right here is showing our delta 1 at expiration. That's behaving like shares of stock between there. So we could have any kind of a profit between 650 gain and a 350 loss. So they're all possible along that curve, just depending on where the stock is. But now let's overlay the current curve. So remember that we have the expiration graph, which right here is in blue, but the current curve shows us our theoretical prices right now. So this might be with 30 days until expiration. So the way that we read the black curve is exactly the same as the blue. You pick a stock price. Maybe we say, what if the stock is 110 today? I trace a line up to the black, and I look left, and it looks like it might be 350 or so, would be the profit. If it happened at expiration, I find 110, but now I go all the way to the blue because the blue is the expiration graph. So on this side of the graph, this black line is going to move up. We're going to have positive theta. Over on this side, it's going to move down. All right, so that's what the current curve is showing us. But now we're going to do another assumption. I go into the pricing model. I say we're going to make 15 days come off the clock, so we have 15 days left, and we're going to put the stock right there at 110. What's it going to tell us? Well, at that point, the black line has shifted a little bit to the gray. You can see right here it's showing that we have 15 days till expiration. And if we trace a line up there, it tells us that we have a profit of $4.20. Now remember, this is a profit and loss diagram. It's not what's called a payoff diagram. A payoff just shows what the spread would be worth. This is what lands in our pocket as a net profit, $4.20. But We've got $2.30 remaining. Remember, we've got $6.50. So yes, we've banked, or at least we could bank $4.20 right now, but we've also got another $2.30 remaining. And this is going to land in there quickly because we're in the final 2 weeks. So now it's kind of a dilemma. You've kind of worked so hard, so to speak, for this first $4.20 to show up, and now it's going to be relatively easy for that next $2.30. Of course, there's other issues. We've got negative gamma to contend with here, but it still kind of creates a puzzle for traders. They're going, should I continue holding? You know, the market looks like it's going to rally, or at least not fall in this case, and I'm going to get this additional profit. I mean, that's another 50-some% right there, more than 50% of what we've already made. So it's certainly tempting to want to hold it, and a lot of traders do that. And I'm not saying that that's necessarily bad. What I am saying is that you are missing a danger. So what we have to do is to say the 100-105 vertical is in the money. All right, so or I should say both options are deep in the money. And so what does that tell us? You know, what's it worth? Maybe that's getting close to $5. Doesn't matter that the 100-110 might not be close to 10, but what about the 100-105? And part of my point is we never stop to look at it because we don't see it. And remember, it's always easy to overlook the things that you can't see. So traders go, gee, I don't have a 100-105 vertical spread in my account. Yes, you do. You just don't see it. You're not understanding how to break these spreads apart. It is there, and it's every bit as powerful as if you were holding it by itself. So here's the 100-110 with our superimposed line in gray, remember, with 15 days to expiration. But if we overlaid, now this is a payoff diagram showing just the total value of the 100-105. And with the stock up here at 110, that same pricing model says the 100-105 vertical spread is worth $4.90. The very thing that we said we would never buy. But again, because we didn't buy it, we overlook it. It doesn't matter what it was worth when you bought it. This is what it's worth now. The best that it can do is to help you by 10 cents. That's it. The stock could go to the moon. It could go to 500. It could go to 1,000. And the best you're going to squeeze out is 10 cents. But you could lose $4.90. That's why we call it a danger. There's really nothing here to manage other than to eliminate it, like we talked about last week. Right? So that is a clear danger. It's got to go. So notice that we have the 100-105 in red. We have the 105-110 in green. Even though we didn't place these two trades separately, that's the way we need to learn to see them. That's the way that I'm going to see the 100-110. All right, so now, right now, I could take this fall all the way down. But what if we close the 100-105? See, now I've greatly reduced the amount that I can lose, and yet I can still squeeze out, or at least almost, that additional $2.30. Makes a lot of sense if you know where to look. So let's close the 100-105, net credit of $4.90. Remember, that's what it's worth. The initial cost of the 100-110 was $3.50. That's what we talked about before. So now we have a guaranteed $1.40. Right? Think about it. If we spent $3.50 and we just collected $4.90, we've got $1.40 or 40%. And we're now long the 105-110. But the current market value is $2.80. All right, so what's going to happen here is this. This is now our 105-110. There's our guaranteed $1.40. Notice that here's our zero line right here. This blue line, the very worst that can happen to us now, sits at plus $1.40. That's kind of a nice deal to be in while we're trying to squeeze out this significant other right here, this extra profit. So now it's $2.20 though. Remember before I said it was $2.30. Why is it $2.20? Well, the reason is we kind of shortchanged ourselves, so to speak, because we never collected the full $5 from the 100-105. We got $4.90 of it. So we're missing 10 cents in there. That's a cost of this type of a morph or this type of a hedge. So now our max gain is $2.20, down from $2.30. Not a big difference. And another way to look at it, and I think this is incredibly insightful, what we have really done here mathematically, we have paid 10 cents to lock in $1.40. But who in here would have seen that? Did anybody see that this was the same thing as paying 10 cents to lock in $1.40? So again, where did we pay the 10 cents? Because had we done nothing, and if we were lucky enough to have that stock stay at 110 or higher, we would have squeezed out $2.30 extra. But because we closed the 100, 105, it's been reduced to 220. So you can think of that as a cost. This is another reason why it's so important to understand that debits are credits, credits are debits. People get way too, hooked on that. Receiving a $4.90 credit is exactly the same thing as paying 10 cents for the put, the corresponding put. That's where that 10-cent cost is coming from. But we did that. We lifted this entire curve by plus $1.40. That is not a bad deal. And yet, how many people would have seen that? Okay, so that's the question that I would like to pose to the group. Did you see this danger? And more importantly, did you miss the opportunity? And if you answered yes to either of those, this is where a coach can be worth its weight in gold. And so we'd like to invite you for a free 30-minute one-on-one consultation or assessment, whatever you want to call it. If you have positions that you're currently in and just want to chat about them, find out what a professional trader would do in this case, give them a call. It's absolutely free. The phone number there is 888-809-8058. And again, I just cannot emphasize the benefits in that. And that's part of what I'm trying to show in all of these trader tune-ups. They're little, sometimes we call them nuggets or pearls of wisdom from the trading floors and from the academic worlds and whatever else we have here at Market Rebellion, from all of this trading knowledge that we try to impart on traders to make you better at what you're already doing. We're not even necessarily trying to trade your trading styles and methods. That's fine. We're just trying to show you how to become better at what you're already doing. This is a perfect way to see how that can play out. Now, we've got some fabulous coaches with decades of experience from the trading floors. If nothing else, you get some great stories. I know I've listened to many of them, but they are phenomenal, phenomenal traders, and you will definitely learn a lot. So please give them a call, 888-809-8058. And with that, I want to wish everybody a great rest of the week, and we'll look for you on Thursday, where we're going to talk about danger number 3. And I'll see you then.